I need to tell you something that might sound contradictory at first. We are in a bubble, a significant bubble. By my calculations, we are about 80% of the way into bubble territory, comparable to what we saw in 1929 and 2000. The artificial intelligence trade has pushed valuations to levels that are among the most optimistic in nearly a century. And yet, I am not telling you to sell everything and run for the hills. This confuses people. They ask me, Ray, if we are in a bubble, why would not you sell? If you see the danger coming, why stay invested? The answer to that question reveals everything you need to know about how markets actually work, how bubbles actually form and pop, and most importantly, how you can protect yourself while still participating in what could be the final stages of significant gains. Let me start by explaining what I mean when I say we are 80% into bubble territory. I have studied every major bubble in modern history. The tulip mania in Holland in the 1630s, the South Sea bubble in 1720, the stock market bubble before the 1929 crash, the Japanese asset bubble in the late 1980s, the dot-com bubble that peaked in 2000, the housing bubble that led to 2008. Each one followed a remarkably similar pattern, and each one had measurable characteristics that appeared in sequence. When I look at markets today, particularly in the artificial intelligence sector and the mega cap technology stocks, I see most of those characteristics present. Not all of them, which is why I say 80% rather than 100%, but enough of them to warrant serious attention and careful positioning. The first characteristic is stretched valuations. Companies are being priced for perfection, for growth rates that historically have been impossible to sustain. The second is concentration of wealth and market capitalization. A tiny number of stocks now represent an enormous percentage of major indices. The third is leverage. Investors are borrowing money to amplify their bets. The fourth is widespread participation by people who do not normally invest in stocks. The fifth is a narrative so compelling that it silences skeptics. The sixth is insider selling and smart money beginning to rotate out. The seventh is signs of excess speculation in related areas, like cryptocurrencies. The eighth is growing disconnect between fundamentals and prices. We have all of these except the final two characteristics, which are usually the ones that indicate a bubble is about to pop. Those are a clear catalyst for tightening financial conditions, like aggressive monetary policy tightening or a sudden credit crunch, and panic selling or forced liquidations that create a self-reinforcing downward spiral. Without those final characteristics, bubbles can persist much longer than rational analysis would suggest. They can even accelerate. This is why I say do not sell just because there is a bubble. Timing matters enormously. The period between recognizing a bubble and the bubble actually popping can be months or even years. And during that time, prices can continue rising dramatically. Think about the dot-com bubble. By late 1998, it was clear to anyone paying attention that internet stocks were overvalued. Price-to-sales ratios had reached absurd levels. Companies with no profits and questionable business models were valued in the billions. And yet, the bubble did not peak until March of 2000, more than a year later. If you had sold in late 1998 because you identified the bubble, you would have missed enormous gains. The NASDAQ nearly doubled between the end of 1998 and its peak. The same pattern appeared before 1929. By 1928, it was obvious to sophisticated observers that stocks were overvalued and that margin lending had reached dangerous levels. But the market kept climbing through most of 1929 before finally crashing in October. Early sellers missed significant profits. This is the paradox of bubbles. They are easiest to identify well before they pop, but identifying them early does not help you much if you act too soon. You need to understand not just that you are in a bubble, but where you are in the bubble's life cycle. So let me explain where I think we are right now and what that means for your portfolio decisions. The artificial intelligence trade began gaining serious momentum in early 2023 when ChatGPT demonstrated capabilities that surprised even experts in the field. Suddenly, AI went from being a future possibility to a present reality. Companies that made the chips and infrastructure for AI saw their valuations soar. NVIDIA became one of the most valuable companies in the world. The so-called Magnificent Seven tech stocks drove almost all of the market's gains. This created a self-reinforcing cycle. Rising stock prices made these companies more valuable, which gave them more capital to invest in AI, which justified even higher valuations. Investors who missed the initial move felt compelled to chase performance. Asset managers who were underweight technology underperformed their benchmarks and faced redemptions. This forced them to buy the very stocks that had already risen the most, pushing prices even higher. By mid-2025, we reached a point where growth expectations embedded in these valuations became truly extraordinary. Investors were pricing in not just continued growth, but accelerating growth for companies that were already enormous. They were assuming that the massive investments in AI infrastructure, the billions being spent on chips and data centers and networking equipment, would all generate returns that justified current prices. This is where my concern intensifies. History shows that when you make massive infrastructure investments in a new technology, the returns are usually much more dispersed and delayed than early investors expect. Some companies will do extraordinarily well, many will fail, and even the winners often take longer to generate profits than optimists predicted. Consider what happened with the railroad boom in the 1800s, the electricity boom in the early 1900s, the personal computer boom in the 1980s, the internet boom in the 1990s, and the mobile computing boom in the 2000s. In each case, the technology was genuinely transformative. In each case, early investors dramatically overestimated how quickly profits would materialize and underestimated how much competition would develop. The railroads transformed America, but most railroad companies went bankrupt. Electricity changed everything, but most electricity companies earned modest returns. Personal computers created entirely new industries, but the PC manufacturers themselves had brutal margins. The internet was revolutionary, but most dot-com companies never made a profit. Smartphones changed how we live, but only a handful of companies captured most of the value. I believe artificial intelligence will be similarly transformative. It will change how we work, how we create, how we make decisions. It will boost productivity and enable capabilities that seem like science fiction today. But that does not mean the companies currently dominating the AI trade will be the ultimate winners, or that they will grow fast enough to justify their current valuations. This is why Bridgewater made significant changes to our portfolio in the third quarter. We reduced our NVIDIA holdings by 65%, cutting from 7.23 million shares to 2.51 million shares. We cut our Alphabet stake by 52%, our Microsoft holdings by 36%, and our Meta position by nearly 50%. These were not small adjustments. These were major reductions in our exposure to the most crowded trades in the market. At the same time, we did not exit these positions entirely. We still own 2.5 million shares of NVIDIA. We still have substantial holdings in the other mega cap technology companies. We increased our positions in chip equipment makers like Applied Materials and Lam Research. We boosted our index fund holdings significantly. We diversified into more areas of the market. This is the key insight I want you to understand. Being concerned about a bubble does not mean abandoning all exposure to the assets in that bubble. It means adjusting your positioning to reflect the changed risk-reward profile. It means taking some profits after extraordinary gains. It means diversifying so that you are not entirely dependent on a few crowded trades. It means preparing for multiple possible outcomes rather than betting everything on one scenario. Let me walk you through the specific risks I see and how they might play out. The first risk is that AI investments may not generate expected returns. Companies are spending enormous amounts on AI infrastructure. NVIDIA alone has guided to revenues that imply its customers are spending well over $100 billion annually on AI hardware. Add in software, services, energy costs, and talent, and the total AI spending is likely several $100 billion per year across the industry. For these investments to pay off, companies need to find ways to monetize AI that generate returns exceeding these massive costs. Some will succeed. Large language models are already proving useful for customer service, content generation, code writing, and data analysis. But many AI projects will fail to justify their costs. There will be a shakeout, just as there was with previous technology waves. When that shakeout begins, investors will become more discriminating. They will stop bidding up every company that mentions AI and start focusing on actual profitability and cash flow. This could happen gradually through multiple quarters of disappointing guidance, or it could happen suddenly through a handful of high-profile project cancellations. The second risk is increased competition. Right now, NVIDIA dominates AI chip production, but every major technology company is working on alternatives. Google has its own tensor processing units. Amazon has its Graviton and Inferentia chips. Microsoft is developing its own silicon. Even Meta and Tesla are building custom AI chips. Meanwhile, traditional chip companies like AMD and Intel are trying to catch up. Chinese companies are developing their own solutions despite export restrictions. This competition will pressure margins eventually. It always does. When NVIDIA faces real competition for AI chip sales, it will have to choose between lowering prices or losing market share. Either way, the extraordinary margins it enjoys today will compress. This does not mean NVIDIA will be unsuccessful. It means NVIDIA is unlikely to maintain current profit margins indefinitely. The third risk is regulatory intervention. Governments are starting to pay serious attention to AI development and concentration. They are concerned about data privacy, algorithmic bias, market power, national security implications, and potential job displacement. Increased regulation could slow AI adoption, raise costs, or fragment markets. It could also create uncertainty that causes investors to reassess valuations. The fourth risk is a macroeconomic slowdown. Despite recent optimism about avoiding recession, significant headwinds remain. Government debt levels are at peacetime records in many countries. Interest rates are still elevated compared to the past 15 years. Geopolitical tensions continue across multiple regions. Consumer savings rates have declined. Credit card debt is rising. Commercial real estate faces major challenges. We are not in a crisis, but we are not in a position of great strength either. If we do slide into recession, or even if growth merely disappoints, companies will cut their AI spending. They always cut discretionary technology spending when times get tough. This would immediately impact the companies supplying AI infrastructure and could cause a sharp revaluation. The fifth risk is the one I am most concerned about, and it relates to debt. We are in the late stage of a long-term debt cycle. This is a concept I have spent decades studying and writing about. Debt cycles follow predictable patterns. They begin after a crisis, when debt levels are low and creditors are cautious. Gradually, as the economy grows and memories of the previous crisis fade, lending standards loosen, debt levels rise relative to income. Asset prices rise, which makes borrowers appear more creditworthy, which encourages more lending. This creates a self-reinforcing cycle. Eventually, debt service costs become burdensome. Borrowers struggle to make payments. Lenders become cautious. Asset prices stall or decline. This reduces collateral values and makes refinancing difficult. Some borrowers default. Lenders pull back further. A downward spiral begins. We saw this pattern in 2008 with housing debt. We are seeing similar dynamics today, but across multiple areas. Government debt has exploded. Corporate debt remains elevated. Household debt is manageable in aggregate, but shows concerning pockets of stress. Private credit markets have grown enormously, often with looser underwriting standards than traditional bank lending. The relationship between debt levels and asset prices is not linear. For long periods, rising debt supports rising asset prices with no obvious consequences, but there are tipping points where the dynamics reverse suddenly. We may be approaching such a tipping point, especially if interest rates remain elevated or if economic growth disappoints. This is why I emphasize government credit as my primary concern. Sovereign debt problems are much more difficult to resolve than private sector debt problems. Governments cannot easily default or restructure. Their options are limited to some combination of higher taxes, lower spending, financial repression, or inflation. None of these options are politically easy, and all of them have negative consequences for asset prices. The United States ran fiscal deficits exceeding 6% of GDP even during recent years of economic growth. This is unusual and concerning. It means that deficit spending is no longer just a counter-cyclical tool used during recessions. It has become structural. And with interest rates higher than recent decades, the cost of servicing this debt is consuming an increasing share of the federal budget. Other developed countries face similar or worse debt dynamics. Japan has been dealing with this for decades. European countries have limited fiscal flexibility due to their monetary union structure. China used debt-fueled investment to power its growth for years and is now dealing with the consequences in its real estate sector. All of this matters for asset prices because sovereign debt problems eventually force central banks to choose between allowing defaults and financial instability or printing money and accepting inflation. Both choices have negative implications for the value of financial assets in real terms. Now, here is where the timing question becomes crucial. These debt dynamics could persist for years before reaching a crisis point. Japan has sustained extremely high debt levels for 30 years without a bond market collapse. The United States has substantial advantages, including reserve currency status and deep liquid financial markets. Problems that would cause a crisis in a smaller country can be managed much longer by a country like the United States. This is another reason why recognizing a bubble does not automatically mean you should sell. Structural problems can persist much longer than you expect, and during the time they persist, other forces can dominate. Right now, despite debt concerns, we have had falling unemployment, resilient consumer spending, and strong corporate earnings, at least in the technology sector. These factors support asset prices even as long-term risks build. So what should you actually do with this information? Let me give you specific guidance based on how we are thinking about portfolio positioning. First, reduce concentration in your most crowded positions. If you have enormous exposure to a small number of mega cap technology stocks, especially after they have delivered extraordinary returns, take some profits. You do not need to sell everything, but you should not have your entire financial future dependent on continued exceptional performance from a handful of companies. The math of portfolio management suggests that once a position becomes large enough through appreciation, the asymmetry of future returns changes. Your upside is still 100% minus transaction costs. Your downside remains 100% But the impact on your total portfolio of that position declining is now much larger than when you initially bought it. This is why we reduced but did not eliminate our positions in Nvidia and the other mega cap stocks. We took profits after extraordinary gains. We rebalanced toward more diversified positions. But we maintained exposure because the positive scenario, where AI develops faster and more profitably than even current prices suggest, remains possible. Second, increase your allocation to broad market index funds. This is what we did by increasing our S&P 500 ETF holdings by 75%. Index funds give you participation in market gains, but with much less concentration risk than holding individual stocks. They automatically rebalance as company weights change. They avoid the temptation to hold losing positions too long or sell winning positions too early. In bubble environments, index funds also provide a useful psychological benefit. If the bubble continues inflating, and you are underinvested in the leaders, being in an index means you still participate somewhat. If the bubble pops, you are much less exposed than those who were concentrated in the highest flyers. Third, look for less crowded opportunities within the same theme. This is why we initiated a position in applied materials and increased our Lam research holdings. These companies benefit from AI infrastructure spending, but they are suppliers to the ecosystem rather than the most visible names. They sell equipment that multiple companies need, regardless of which specific AI companies win. They trade at more reasonable valuations than the headline names. And they face less competition because semiconductor manufacturing equipment requires enormous expertise and has high barriers to entry. This approach is about finding ways to maintain thematic exposure while improving your risk-reward profile. You are not abandoning the theme entirely. You are positioning in parts of the value chain where valuations are more attractive and competitive dynamics are more favorable. Fourth, increase your geographic diversification. We increased our emerging market exposure in the third quarter. This reflects a recognition that United States equity markets have become extremely expensive relative to international markets. The valuation gap between United States stocks and the rest of the world is near historic extremes. This does not mean international stocks will outperform next quarter or even next year. But over longer time horizons, reversion to the mean suggests international stocks should provide better returns from current levels. Emerging markets in particular offer exposure to economies that are earlier in their development cycles, have different debt dynamics than developed markets, and have growing middle classes that will drive consumption growth for decades. They come with different risks, including political instability and currency volatility. But as part of a diversified portfolio, they provide valuable exposure to different economic drivers than United States markets. Fifth, maintain significant exposure to real assets. We have long advocated for meaningful allocations to gold as part of a balanced portfolio. Gold reached all-time highs this year, which reflects ongoing concerns about inflation, currency debasement, and geopolitical instability. In an environment where I am concerned about sovereign debt and the late stages of a debt cycle, gold provides insurance against the tail risk that governments resort to money printing or financial repression. Real estate, commodities, infrastructure, and other real assets also play a role in portfolios positioned for late cycle dynamics. These assets often perform differently than financial assets during periods of inflation or currency instability. They provide diversification that becomes valuable precisely when conventional financial assets face challenges. Sixth, keep some dry powder. This is perhaps the most difficult advice to follow in a bubble environment because it means accepting lower returns while the bubble inflates further. But having liquidity available means you can take advantage of opportunities when they arise. If the AI bubble does pop and valuations correct sharply, you want to have capital available to deploy at better prices. This does not mean sitting entirely in cash. Cash yields nothing in real terms after inflation and taxes. But it does mean not being fully invested at all times. It means having some allocation to short-term bonds or money market funds. It means not using leverage. It means maintaining positions that you could liquidate quickly if you needed to act it. Now let me address the question everyone really wants answered. When should you sell? If we are in a bubble that will eventually pop, at what point do you need to get out? The honest answer is that I do not know exactly. Nobody does. Market timing is extraordinarily difficult, even with sophisticated models and decades of experience, but I can tell you the signs I am watching that would cause us to become more defensive. The first sign would be clear monetary tightening beyond what is currently priced in. Right now, markets expect the Federal Reserve to hold rates steady or possibly cut modestly in the coming months. If instead the Fed signals it needs to raise rates significantly to combat inflation, that would create the tightening of financial conditions that often pricks bubbles. Higher rates make borrowing more expensive, which pressures leveraged positions. They make future earnings less valuable in present value terms, which directly impacts growth stock valuations. They strengthen the dollar, which hurts multinational companies. They increase the attractiveness of bonds relative to stocks. A shift to aggressive tightening would be a clear signal to reduce risk significantly. This does not appear imminent based on current inflation and growth data, but it is something we monitor constantly. The second sign would be signs of forced liquidation or deleveraging. In 2008, we saw Bear Stearns and Lehman Brothers fail. We saw hedge funds liquidating positions to meet margin calls. We saw money market funds breaking the buck. These were indications that the system was experiencing stress and that selling would become self-reinforcing. Today, we would watch for hedge fund blow-ups, rapid widening of credit spreads, difficulty in refinancing commercial real estate loans, runs on regional banks, or other signs that some part of the financial system is experiencing acute stress. So far, these signs are not present. Financial conditions remain generally supportive, but we have monitoring systems designed to detect stress early. The third sign would be a shift in AI spending guidance from major companies. Right now, technology companies are consistently guiding to continued heavy AI investments. Microsoft, Amazon, Google, and Meta are all committing tens of billions of dollars to data center build-outs and AI infrastructure. If several of these companies were to suddenly announce spending cuts or project delays, it would signal that the expected returns are not materializing. This would cause immediate reassessment of the entire AI supply chain. We watch earnings calls, investor presentations, and capital expenditure guidance carefully. Any indication of wavering commitment to AI spending would be concerning, not because AI is not important, but because it would indicate the current pace of investment is not sustainable. The fourth sign would be significant insider selling beyond normal patterns. Right now, we do see meaningful insider selling at some of the mega cap technology companies. This is not unusual after stocks have appreciated enormously. Founders and early employees have most of their net worth tied up in company stock, and diversification is prudent. But if we saw coordinated selling by multiple insiders at multiple companies, or selling by CEOs and CFOs who typically hold for the long term, it would suggest those closest to the business have concerns about sustainability. The fifth sign would be a negative catalyst that changes the narrative. Bubbles need narratives to sustain them. The AI narrative right now is that we are in the early stages of a transformation as significant as the internet or the Industrial Revolution. If something happened to challenge this narrative, like a high-profile AI failure, a major security breach, or evidence that AI capabilities have hit a ceiling, sentiment could shift quickly. Narratives are fragile, they seem unassailable until suddenly they are not. In 2000, the narrative was that internet companies did not need profits because they were building market share in a winner-take-all world. That narrative sustained absurd valuations until it became clear that many of these companies would never be profitable. Then the narrative collapsed almost overnight. Without any of these signs, my view is that the bubble can persist longer and that the better strategy is to rebalance gradually rather than exit dramatically. This is about risk management, not market timing. It is about recognizing that we are in a high-risk environment, but that high-risk environments can persist for extended periods. I also want to address the emotional and psychological aspects of this situation because they matter enormously for investment success. Investing in a bubble creates intense psychological pressure. If you are underweight the bubble sectors, you watch as others make enormous profits. You feel stupid. Your clients or friends question your judgment. You face career risk if you are a professional investor. This pressure often causes people to abandon their discipline and chase performance at exactly the wrong time. If you are overweight the bubble sectors, you experience different pressures. Valuations are stretched, but greed and fear of missing out keep you invested. You make excuses for why this time is different. You find reasons to believe the high prices are justified. You tell yourself you will sell when you see the peak, even though you know intellectually that peaks are only obvious in hindsight. The key to navigating these pressures is having a systematic process that you commit to in advance. Decide now what percentage of your portfolio will be in high-risk concentrated positions versus diversified holdings versus cash or defensive assets. Decide now what will cause you to rebalance. Write it down. Share it with someone you trust. This makes it harder to abandon your discipline in the heat of the moment. At Bridgewater, we use systematic frameworks for exactly this reason. We have quantitative models that measure various characteristics of market environments. We have risk management rules that automatically trigger when certain conditions are met. We have a culture of radical transparency where we challenge each other's thinking and force ourselves to examine our assumptions. These systems exist precisely because we know that human emotions and biases lead to poor decisions during extreme market conditions. You need similar structures for your own investing scaled to your situation. If you do not have formal models or risk management systems, simple rules work well. Rebalance annually back to target allocations. Take profits when positions exceed some predetermined percentage of your portfolio. Never use leverage. Always keep some percentage in defensive assets. Follow these rules regardless of how you feel in the moment. Let me also address the argument that AI is different. That this time the technology really will generate the expected returns. I hear this constantly. People point to the rapid progress in large language models, the obvious use cases, the potential for AI to boost productivity across every industry. They argue that betting against AI is like betting against the internet in 1995. I do not disagree that AI is genuinely important. I believe it will be transformative, but that does not mean current valuations are justified. The internet was genuinely transformative. It changed how we communicate, shop, work, and entertain ourselves. And yet, the vast majority of internet companies that went public in the late 1990s failed. Even those that survived often saw their stocks decline 90% or more from peak to trough. Amazon is an interesting case study. It was one of the biggest winners from the internet revolution. It built a dominant position in e-commerce and later in cloud computing. Today, it is one of the most valuable companies in the world. And yet, if you bought Amazon stock at the peak in 1999, you lost 95% of your money by 2002. It took nearly 10 years to get back to break even. The company was successful. The technology was transformative, and early investors at peak prices still lost enormous amounts of money. This is what I mean when I say that a transformative technology does not guarantee good investment returns at any price. Timing and valuation matter enormously. The companies building AI infrastructure today may be successful. They may dominate their markets for decades. But if you pay too much today, you can still lose money even if everything goes well. This is not pessimism. This is math. If you pay 50 times sales for a company, that company needs to sustain extraordinary growth rates for many years just to grow into its valuation. Any disappointment, any slowdown, any competition, and the stock can fall dramatically even if the long-term story remains intact. So when I say we are in a bubble but do not sell yet, I am not making a market timing prediction. I am describing a risk management framework. High valuations and bubble characteristics mean risk is elevated. Elevated risk means you should reduce concentration and increase diversification. But elevated risk does not mean immediate collapse. It means preparing for multiple scenarios while maintaining flexibility to adjust as conditions change. I want to be clear about something else. While I am concerned about bubbles in certain pockets of the market, I remain fundamentally optimistic about human ingenuity and economic progress over the long term. Markets have cycles. They go through periods of excess and periods of pessimism. But over long time horizons, markets go up because humans are innovative and productive, companies figure out ways to create value, economies grow, living standards improve. This is why I never advocate abandoning markets entirely. Even at the peak of bubbles, the solution is not to sell everything and hide. The solution is to position appropriately for the risks you perceive while maintaining exposure to the long-term upward trajectory of markets. This is the philosophy behind our all-weather strategy, which aims to perform reasonably well across different economic environments rather than making big binary bets. The current environment requires particular attention to balance. We face legitimate concerns about valuations, debt levels, and geopolitical tensions. We also have powerful tailwinds from technological innovation, growing global middle class, and central banks that remain supportive of growth. Navigating these crosscurrents requires humility about what you can know, discipline about risk management, and flexibility about changing course when conditions change. One more critical point about the current situation. The concentration in markets is extreme by historical standards. The top 10 stocks in the S&P 500 now represent about 33% of the index's market capitalization. This is similar to the concentration we saw at the peak of the dot-com bubble. The vast majority of the index's gains in recent years have come from a small number of mega-cap technology stocks. This concentration creates risk that people often underestimate. If you own an S&P 500 index fund, you might think you are diversified across 500 companies, but in reality, you have enormous exposure to a tiny number of stocks. If those stocks decline, your supposedly diversified portfolio will decline significantly, regardless of what happens to the other 490 companies. This is why we increased our holdings of equal-weighted index funds and why we expanded from about 585 individual positions to over 1,000 positions in our portfolio. We are deliberately seeking broader diversification to offset the concentration risk in market cap-weighted indices. For individual investors, this might mean allocating some money to equal-weighted index funds, small-cap funds, international funds, or other vehicles that reduce your concentration in the mega-cap technology stocks. It does not mean avoiding those stocks entirely. It means recognizing that having 30 or 40% of your equity portfolio in 7 stocks is not as diversified as it might feel. Let me address one final question that I get asked frequently. What about Bitcoin and cryptocurrencies in this environment? I hold about 1% of my portfolio in Bitcoin, and I have for years. I view it as a diversifier with potential value in certain scenarios, but with significant limitations that prevent me from having high conviction or large allocations. Bitcoin faces structural challenges as a reserve asset. It is traceable, which governments dislike. It is vulnerable to potential quantum computing advances. It has high volatility that makes it difficult to use for transactions. It lacks the institutional support and stability that true reserve currencies require. These limitations mean I am skeptical it will achieve the loftiest predictions of its advocates. At the same time, Bitcoin has demonstrated remarkable resilience. It has survived numerous predictions of its demise. It has gained acceptance among institutional investors. It serves as a hedge against currency debasement and government overreach. In an environment where I am concerned about sovereign debt and potential financial repression, having some exposure to an asset outside the traditional financial system makes sense. The key word is some. 1% is enough that if Bitcoin does extraordinarily well, it meaningfully impacts my portfolio. But it is small enough that if Bitcoin goes to zero, it does not materially hurt me. This is appropriate sizing for an asymmetric bet on an asset with huge uncertainty. The recent decline in Bitcoin, falling below $90,000 after reaching new highs, reflects the same risk-off sentiment affecting other speculative assets. When investors become nervous about bubbles and valuations, they tend to sell their most speculative positions first. This often includes cryptocurrencies. So the weakness in Bitcoin is consistent with the broader pattern I am describing, where investors are becoming more selective and risk-aware. To summarize everything I have told you, here is my framework for thinking about the current environment. We are in the late stages of a long-term debt cycle. We are seeing stretched valuations in certain parts of the market, particularly AI-related technology stocks. We have concentration risk at historic levels. We have geopolitical tensions and policy uncertainty. These factors all point to elevated risk. At the same time, we do not have the clear catalyst that typically pricks bubbles. Monetary policy is supportive, financial conditions are not tight. There is no forced selling or deleveraging. Economic growth remains positive. Corporate earnings are strong, at least in technology. The AI narrative remains intact. This combination means it is too early to become dramatically defensive, but it is past time to start rebalancing and preparing. The appropriate actions are reducing concentration in the most extended positions, increasing broad diversification, maintaining exposure to multiple themes and geographies, keeping some dry powder for opportunities, and being prepared to become more defensive if warning signs develop. This is not a forecast that markets will crash tomorrow. It is not a prediction that AI stocks will collapse next quarter. It is a recognition that risk is elevated and that prudent risk management suggests repositioning now rather than waiting for obvious signs of trouble. By the time trouble is obvious, it is too late to adjust without significant losses. I have been doing this for over 50 years. I have lived through many market cycles. I have made plenty of mistakes and learned from them. The biggest lesson is that the hardest time to be disciplined is when everything seems to be working. When markets are rising, when your portfolio is growing, when everyone around you is optimistic, it feels foolish to talk about risk management. It feels like you are missing out. But risk management is not about avoiding risk entirely. It is about taking appropriate risks with appropriate sizing and appropriate hedges. It is about recognizing that the future is uncertain and that positioning for multiple scenarios is smarter than betting everything on one outcome. It is about understanding that protecting capital is just as important as growing capital, and that you cannot grow capital in the long run if you lose it all during the inevitable downturns. So yes, we are in a bubble. Yes, I am concerned. But no, I am not selling everything. I am rebalancing, diversifying, and preparing. I am maintaining exposure to the scenarios that could still play out positively while reducing my vulnerability to the scenarios that could play out poorly. This is not exciting. It does not make for dramatic headlines, but it is how you preserve and grow wealth over decades rather than gambling it on short-term predictions. The market environment we face today is challenging precisely because it requires holding two seemingly contradictory thoughts simultaneously. Valuations are stretched and risks are elevated, and yet opportunities remain, and the path forward is uncertain. Success requires neither blind optimism nor excessive pessimism. It requires careful analysis, disciplined risk management, and the humility to adjust as circumstances change. This is what I have tried to do at Bridgewater for decades, and it is what I am doing now in my personal portfolio. I hope this framework helps you think through your own positioning and prepares you for whatever comes next in these fascinating and challenging times.